Thank you for joining us for the second day of our virtual ILS Asia 2020 conference. I hope you enjoyed yesterday's sessions. This morning, we're going to be talking about parametric risk transfer opportunities in Asia. And this is a topic that we touched on briefly yesterday with respect to catastrophe bonds and the activity seen in Asia and some of the parametric structures seen there. But we haven't really done a deep dive into parametric risk transfer as a whole during any of our Asia ILS conferences to date. So this year, I wanted to get some experts on board to talk through parametric triggers as a form of risk transfer, how activity is accelerating at the moment, and also what the opportunities are for cedents, those in the traditional market, but also in the ILS market as well as parametric interest expands. So today, I'm delighted to be joined by three experienced speakers. We have Andre Martin, who's Head of Innovative Risk Solutions, Asia Pacific in Swiss Re Corporate Solutions. We have Eden Leroux, who is Head of ILS and Cat Modeling at Descartes Underwriting, a specialist parametric-focused MGA. And we have Raphael Rayees, who's a portfolio manager for traded ILS at specialist ILS investment manager Securities Investment Partners, LLP. So to begin, I thought it might be useful to just go round our panelists and ask them to briefly explain their roles and how parametric risk transfer plays into them. So let's begin with you, Andre.
Yeah, thanks, Steve, and yeah, good morning, good afternoon, good evening. Yeah, my name is Andre Martin, working for Swiss Re Corporate Solutions, which is part of Swiss Re Group. I have been with the Swiss Re Group for the past 18 years and worked in different locations, so Zurich, and then Sydney, and then moving up to Singapore. Currently based in Singapore, and I'm heading this entity called Innovative Risk Solutions for APAC. What we do is really, we are responsible basically for the origination and the structuring and also the execution for what it's largely known as alternative risk solutions. And quite a large part of that is actually parametric insurance. At the moment, the portfolio is a large degree is still nat cat, so natural perils, but certainly expanding slowly and but surely into non-weather indices as well.
Great, thank you, Andre. And Eden, I'll call on you next.
Yeah, thank you, Steve. So as you just said, Descartes Underwriting is an MGA dedicated to the underwriting of parametric insurance risks. And my role there at Descartes is to develop the ILS part of our risk carriers ecosystem, which also includes insurers and traditional reinsurers.
Great, thank you, Eden. And Raphael?
Hi, everyone. So I am Raphael Rayees. So at Securities, we're a 5 billion AUM asset manager, and we invest primarily and specifically in insurance assets. I look after our cat bond investments and any liquid investments we might have, and I also get involved with any non-typical reinsurance type transactions. So the bulk of our parametric portfolio currently today is within our cat bond mandates and within our cat bond AUM. But we do also look at private deals from time to time. Typically, we will see them through our partner reinsurance companies and then sometimes via the reinsurance distribution network.
Great, thank you, Raphael. So just a quick note for the audience and those listening, we have got the ability for you to send us questions. If you enter them into the Q&A box, they'll pop up here in front of me and we'll try and get to some of them, maybe during the session, but if not, then at the end, we'll try and run through a few of them. So to move on with the conversation, Andre, I thought we'd go to you first, as you're up the kind of the front end of the parametric food chain, providing risk transfer on the corporate and commercial level. So it's a significant potential source of risk in Asia for the reinsurance and ILS market, and obviously your own book in corporate insurance. And parametrics have obviously been in use for a number of years, but can you talk us through some of the activity you see on a daily basis and how you've seen that increase over the last few years?
Yeah, No, happy to do that. So, I mean, as you say, I mean, parametric insurance is not that new, but it's only over the last, I think, 5 to 10 years that it's really moving out of this more exotic space in the insurance sector to more the mainstream side, and certainly it's becoming more and more popular also with corporate risk managers to use this as an alternative and to complement their traditional programs. Now, here in Asia, as I said before, I mean, I think we have our fair share of nat cat exposure. So most of the requests at the moment that we're getting is still related to earthquake and typhoon. But I think climate change, especially over the last 2 years, climate change has become very real, very visible, and painful for corporations. So what we're seeing now is more requests around parametric solution for what we call the secondary perils, like bushfire. We have triggers for flood exposure or hailstorms. So that's really on the cat side. And then obviously, I mean, moving outside of the nat cat area, I mean, we have the whole area of agriculture business. I mean, that's certainly a big part in India, yield-based or weather index-based. But then moving out of that agriculture, we see renewable energy companies coming and hedging their revenues with wind hedges or solar hedges. And I think over the last few years, more and more than shifting also outside of the weather into the more non-weather indices. And here, just to say examples, I mean, hotel occupancy rates would be one, or threat of terrorism. So a whole range of possibilities and potential that we're looking at the moment, also in this region.
And you're seeing the appetite for that increasing from buyers?
Definitely increasing. It's certainly something where we see, I mean, if I look geographically, I mean, Japan, I mean, taking out the agricultural, which is long-standing in India, but I mean, from a corporate perspective, I would say that Japan is still leading the way. Earthquake, I mean, they've been doing it for quite a number of years, but risk managers are really warming up to the concept. It's still educational, still awareness creation, but they're warming up, and we see really a number of deals being executed every month, and really across the whole region. So I mean, be it tropical cyclone in Australia, earthquake in Indonesia, in Philippines, and then quite some activity also in China.
Interesting, thank you. So moving on to Idern, your role, obviously you focus on developing ILS capacity specifically for parametrics at Descartes, and Descartes' specialist underwriter. How active is Descartes in Asia at the moment, and how do you see the region developing in terms of its uptake of parametric products?
So our portfolio is spread over the 5 continents. And Asia is one of our key areas of development. Natural catastrophes in Asia are among the most intense in the world, and there is a huge need of protection and to cover these risks. As for other regions in the world, parametric is steadily growing in Asia with the increased availability and accuracy of data sources. It allows us to broaden the scope of perils covered, as André said, bushfire, for example. We are also seeing jumps in demand levels for peril regions that have suffered losses recently and that are experiencing a very hard market. So, for example, we see a lot of requests for Japan typhoon after Jibai and Hagibis. We also observe a strong demand for Hong Kong typhoon after Typhoon Mangkhut, and also in Australia after the recent cyclones, hail, and bushfire events. Also, Asia is combining very high level of risk with very large exposures. For example, we have recently seen many Asian countries are building giant offshore solar panels, plants, and wind farms, and it requires a huge capacity in the market. So yeah, Asia is a key region for us.
Interesting. And Descartes, you're very focused on the data side of things as well, aren't you? I know you've developed technology around this. And is Asia an easy region from that point of view? Do you find data readily available, or is it a bit more of a struggle than in some other regions like the US, where perhaps it's more developed?
The best region for data is the US, with data is freely available, and it's I think it's written in the law that the public agency are providing data on a freely and publicly available basis. In Asia, you still have access to satellite data relatively easily, but it's more difficult to get access to gauge data or wind speed data, for example. So yeah, we have partnership with some companies to get access to these. And we also directly install our own weather station on site when there is a lack of data availability there.
Okay, interesting. So Raphael, obviously you represent the ILS investor community in this panel session. Can you talk us through the investment case for parametric structured risks, perhaps, and how, as a manager, Securities approaches those transactions?
Sure. So for us, a parametric investment is, and I presume for the rest of the market, it's in scope, so we can consider it, right, when we're getting some sort of excess return over a statistical measure of risk. And what we at Securities can look at, and again, generally the ILS market, is when this source of risk is either driven by some sort of natural phenomenon, so a nat cat perhaps, or some weather event, or also I think you can go broader than that, or where you can define the risk as being very random in nature. So where it's not influenced, or not very heavily influenced by the actions of, say, society or man. So the advantages, there are quite a few advantages, especially in a year like 2020. So one is the moral hazard. I mean, for anyone following the ILS landscape, specifically in Florida, perhaps in the US, moral hazard is a very, very big risk for the reinsurance industry and for us in ILS. With parametric structures, you can get away from that. We can really focus on a very narrow risk, limited scope. So you can really try to extract return from a pure form of the risk. The secondary risks are minimal. So what I mean by that is there's less of a concern as to how the actual hazard affects the loss, right? So you're less worried about that. Again, you would have seen that in 2017 in Florida, where areas with very low wind speeds suffered high losses. So with parametrics, again, you're less concerned about that. And what's most interesting this year is you can, again, go back to the pure hazard. So a lot of people in the market this year are concerned about inflation coming from the lockdown just across the globe, really, in Europe, perhaps more so in Europe and the US. And again, with parametric structures, you don't have to be overly concerned about that, really. So a good example of that this year, and the reason why we think that a particular transaction achieved very good execution, was MetroCap. So a parametric surge transaction. There was no concern, again, given it's parametric, on the impact of the lockdowns in the US. And to us, it looked like it got very good pricing and very good execution. Now, saying that, there are also issues we have. So when we look at it, at Securities, we're a very data-driven manager, as I imagine a lot of players in the ILS market are. So what that means by being data-driven is we focus very extensively on what we think the risks and rewards of deals are. From our experience, the commercial cat models aren't built specifically to measure the parametric risk, which might sound unusual, but they're really built to, measure and understand insurance risk, so not necessarily parametric risk. So we're very focused on trying to understand the risk within parametric transactions, and it may mean using some adjusted output from a cat model, or just disregarding a commercial cat model completely and trying to build something with other sources of data. And then again, being very model focused, the other thing we want to think about is what affects the risk, and it could be that certain territories just are unable to accurately report on reliable data, which is in itself fine, as long as we're measuring the uncertainty of that data and capturing it within our model. So typically when we stumble on deals, it tends to be those two areas where we stumble on.
Interesting. We actually have a brief question from the audience, Raphael, just asking, can you elaborate on moral hazard, please, and exactly what you meant by that?
Sure. So again, as an investment manager, most of our assets are in the US. So the examples I have perhaps are more US centric, but you could perhaps see how it could apply in other areas of the world. So with an insurance policy, I guess you are placing a lot of faith in the policyholder to fairly put in a claim, and then you're placing faith in a company at the level we sit at, where we're sitting sort of above that company in the chain. You're placing faith in the company accurately assessing what the claim is, paying a fair claim, so that you're not exposed to something that you couldn't measure. Now, there could be instances where companies might be incentivized to pay perhaps larger claims volumes to keep policyholders in their portfolio. So companies make profits by having policyholders stick with them for a very long period of time and controlling mostly the non-cat claims. The cat claims mostly go to the reinsurance industry. So that's typically an area where moral hazard is an issue. And again, from our perspective, where we're trying to isolate the purest, random risk, the moral hazard can be a distraction.
Sure. Okay. Now that's really helpful, and actually, it's interesting because it also would apply, I suppose, to the potential for collateral to be trapped. That with a parametric transaction, it's much more defined. You know where the triggers and the buffer tables are going to kick in very straightforward manner based on publicly available data, usually as well. So it's a bit different to an indemnity transaction. Thank you. So I thought it'd be interesting to hear sort of all of your opinions on sort of where the Asia market is now in terms of its acceptance of parametric triggers, and perhaps how that differs to the mature markets like the US, where parametrics have been involved for longer. Maybe we could start with you, Andre.
Yeah. I mean, just maybe one comment. I mean, when you're comparing indemnity and parametric insurance, I think one point we always have to keep in mind that, or at least we don't see parametric insurance to be designed to replace traditional indemnity insurance. I mean, we see it more to be complementing it, to sit side by side and really fill the gaps, or as Edan mentioned, just really fill that capacity that's no longer there, instead of replacing. Now, in terms of acceptance here in Asia, I think we have to differentiate. On one hand, obviously in India, we have these large agricultural schemes backed by the government for decades now. I think there is quite an familiarity with index-based solutions. And then obviously we have Japan, where it's also quite popular. But I would say for the rest of corporate APAC, it's still a relatively new concept. And the risk manager is slowly warming up to it. And although there are a lot of transactions being executed here in APAC, I would still see that in this phase, that the whole area around education, awareness creation, and explanation is still very important. One thing that we're encountering quite often here is that because it's still a bit of an, I mean, I wouldn't say that it's immature, but the maturity is not quite as comparable to the US or to Europe. So when we go out explaining parametric insurance, I mean, very often parametric structures get directly compared to indemnity insurance, and that creates a bit of a pitfall. So it's really up to us to, apart from educating a client, also probably then also come up with or using data analytics, using new modeling approaches to also come up with more refined structures. So also to reduce the basis risk and really get that acceptability from the clients that they can really grasp it a bit better.
Interesting, thank you. Eden, in your activities in Asia, do you see parametrics? Are they seen in a different light to how you experience it in the United States?
Not really. I do not see a lot of difference between how the US and Asian clients are reacting to parametric insurance. As Andre said, there's a need of a lot of education. We always have the question about the comparison between indemnity and parametric insurance and how it will react. Yeah, parametric insurance remains a small portion of the overall insurance market, but yeah, it is growing faster, in my opinion. So we will never replace indemnity insurance, but we can really reduce the protection gap by offering, for example, deductibles cover or capacity when it's not available, or to cover perils that are just not insured anymore by indemnity insurance.
Yeah, we'll certainly come on to that topic in a little while. Rafa, from your point of view, the Asian market, obviously there's quite a lot of parametric activity in the ILS space in Asia, and always has been for quite a number of years. And yesterday we referred back to the concentric cat bond back in 1997. Is this a region that you would hope to see more in future?
Yeah, definitely. So I mean, even more recently, I think the World Bank, of course, everyone knows, has done very good work in trying to address the big risk needs, right? And that's where ILS can be useful, right? Because it's hard for us to be able to, realistically, to be able to focus on a large number of transactions, and it's a little bit easier when we see very large deals in the market. We can sort of dedicate our efforts and resources to those deals, and that's where we're probably going to see success in the ILS market, right? The big transactions like the World Bank does, and of course, back in the day, there was quite a lot in Japan that was done as well, so we have people at Securities who focus on this in quite some detail, especially on the whole aspect of, I guess, development risk transfer. So we do think there are definitely areas where we can help. And there are probably areas where just the people out there working on the transaction continue to try to figure out ways to address the need. So, for example, yesterday I was speaking to a head of modeling who was discussing flood risk transfer with me. And of course, there's been success with fintech firms in the UK and Europe on parametric flood risk transfer. But when we go to the level where we, might be able to help, which is those big transactions to get, to help governments manage their flood risk, that's where parametric becomes a little bit more difficult, because it's this very high gradient peril, right? You get very different readings based on exactly where you are. So there's probably a lot of work to be done there, but that is, again, an area for us and for me personally, where there should be interest, right, in the ILS market, because we have these large volumes of capital behind us. Where we can probably not, or rather where we're sometimes not the right form of capital, is also another aspect, right? We typically don't have the capital benefits or the efficiency benefits, both in terms of originating the risk, like the reinsurance companies, the insurance companies, like Andre's firm will have. We won't have the expertise on structuring these deals or the research on understanding the data. But then quite often we just don't have the right execution avenues or the balance sheet. We do have ways to partner with reinsurance companies to build those efficiencies, but sometimes we're just not the right form of capital. And that's why we try to focus on helping people bring the bigger deals to market.
Absolutely. No, that makes perfect sense. Actually, I'm just going to fire a question from the audience to you, Raphael, as well, because it's kind of related to the cat modeling sort of question. So the question is around, so traditional cat models aren't really built for parametric risk as such, but how do you assess forward climate-driven risk within the traditional models that you have available to you when you're looking at transactions such as this, as some of the traditional models are not sort of consistently skillful in that respect?
Yeah, no, great question. And there are two aspects, right? So there's the aspect of how do you assess the changing risk from climate change? That's aspect one. And then there's the other aspect of how do you assess the shorter term risk, right? So of course, there's a lot of forecasts on what the risk in the coming typhoon, but more so sort of Atlantic hurricane season would be. On the former, that's where we've done a lot of work. Again, being a very data-driven, a scientifically oriented firm, we put a lot of resource into understanding how climate change affects the risk. So we don't use the sort of frequency output from the commercial models to assess climate change. We've built our own frequency base because we do, what our research has shown us is the risk is not well captured and well understood. So we've incorporated ways where we think we're now capturing the risk quite well. For us, the perhaps more difficult and more challenging aspect is those shorter term forecasts and how they impact the risk. Because of course, that is what's on everyone's mind. 2017 was the example year when the forecasts were high and we saw high activity. And there are things we can do, but primarily the way we mitigate those risks is to build quite diversified portfolios where we can. And that's interestingly where Parametric typically is useful for us, where given we see large flow really in North America, Parametric transactions are very, very interesting for us because it gives us that diversification that we sometimes need.
Yeah, interesting. It's one of the things I often hear from end investors is a question as to why isn't more of the ILS market parametrically structured, because it makes sense from a portfolio diversification point of view and it's easier to understand for some fixed income investors. Thank you. So there's a lot of discussion at the moment in the market around the world about systemic risks and whether they're insurable or not, and at what level they need public-private partnerships to assist with them, which has really been stimulated, obviously, by the COVID-19 pandemic. It's become a hot topic. But parametric triggers do demonstrate a way that certain discrete exposures can be carved out and dealt with, such as supply chain risks. Yesterday, we saw Chubb announced a pandemic proposal that is partly parametric in nature. Do you think this is a growth area and a future opportunity for parametric trigger expansion and for the product range? Andre, start with you, given that you're at the front end of this.
I think when you're mentioning supply chain, and I think it's a really good example because, I find it a very ideal example for parametric because it's really where you exactly, first of all, you have, when you look at in insurance programs of corporation, it's really an area where there are significant gaps right now with all these non-damage exposures or exposures where you don't have the control. It's certainly an area where parametric can be a very effective tool. Now, as you say correctly, I think for us as a risk taker, it's to quantify and to assess the risk. I think it's extremely important to really drill down what you say, these discrete exposures to individual scenarios and events, because as a risk taker, we just, we are happy to take fortuitous risks that we can model, but we struggle with this all risk element on parametric basis because in the case of supply chain risk, we would probably take a lot of pure business risk or entrepreneurial risk, which we think we're not best positioned for. So I think it's the whole area. How we look at the whole NDBI or non-damage business interruption is really like, well, what are the underlying exposures or discrete events that are causing it, and then try to model this and then really thereby find a solution.
So it's really about wrapping the correct data around a problem so that you can construct a trigger in the first place.
Exactly, and there the whole area. It's phenomenal how advances in data analytics in the last couple of years have really allowed us to come up with new triggers, with new models, with new approaches to really also cover exposures that probably 5 years ago we had no chance of modeling. So and I mean, taking the example of supply chain again, I mean, apart from we've done in Europe low river levels in a hot summer when the rivers can't dock into ports. I mean, also non-weather related triggers like insolvency of key suppliers or closures of crucial railways or road connections. All of this can be done now. So I think it's really expanding as we speak, basically.
Yeah, thank you. Idern, at Descartes, is this an area that you're looking at? Have you done any transactions in this sort of systemic and the NDBI space?
Absolutely. I fully agree with Andre on everything he just said. On the supply chains, there are already a lot of transactions, and we have seen this recently due to the availability of data. Risk managers within companies, they are just gathering more and more data on the location of their suppliers' factories, and thanks to this data, we can build the right product for them. So there are multiple international entities that cover their supply chain risks through parametric insurance, and especially in Asia, as Asia is the largest supplier of many businesses in the world. For example, in the tech industry, we have seen this in Thailand in 2011, where the flood caused a lot of disruption there. And yeah, on the pandemic side, we hope this pandemic will be used by the companies to better assess their systemic or extreme risk, and that they will develop strategies to hedge those risks. Regarding this, parametric is definitely a lever to do it.
Absolutely, yeah, and it's interesting because obviously now the pandemic appears to be raising risk perception, and at the same time we also have the increased pressure from investors and interest in understanding climate exposure as well, the two of which are obviously very related and suited to parametric solutions. Raphael, is these types of risks things that you look at, or are you more focused on peril-specific parametrics?
It's a great question. We often field queries, typically inwards queries, especially on the topic of BI, non-physical damage BI, on whether there are particular parametric structures that could work. Some of them perhaps are not as well thought out as the deals that actually come to market, right? So there's definitely issues with them. Some just wouldn't solve the issue. So there were some ideas to structure something based on mortality to help business owners when their businesses are shut. But of course, the issue why the businesses are shut is to protect mortalities, to reduce mortality. So stuff like that would be an issue. Typically, again, it's where we're giving feedback to the large companies in the market who are trying to put together transactions to then bring something to us. I do think there's definitely something to be done, right? What for me is interesting, especially outside of the US, and outside of really Europe and the US, where the market really is pegged to this form of insurance contract, is I genuinely don't think that that's perhaps the best way forward, right? Sticking to what insurance you typically use. And for me, a good example is away from insurance, right? It's in Africa, right? The mobile banking market there was far more advanced last decade than it was in the UK, for example, right? So it isn't necessarily the case that we need to stick to something that has been developed sort of at a point in time for a specific need of a certain part of the world. And there are definitely other ways around it. So I thought some of the Lloyd's proposals, in fact, were quite interesting. One specifically where we're financing the pandemic, where perhaps the risk transfer is a little bit more limited, but you're providing large volumes of capital and financing it.
Yeah, no, it's interesting. It's something I've always thought is that parametrics provide this quick injection of contingent capital at the time people really need it, and if it's well structured, it's as valuable, perhaps more valuable than a traditional insurance contract under the right circumstances, and certainly as a complement, very, very, very important as well. That actually raises a topic that we haven't mentioned yet, but basis risk. And I guess, Andre, from your point of view, I'd be interested to hear how you help buyers to get beyond the topic of basis risk, how you help them to understand the difference in the protection they're getting, or do your clients come to you very clearly knowing that it's capital that they need under the right specific circumstances?
Well, I mean, that's basically brings me back to what I said in the beginning. I mean, I think a lot of education is still needed. And the basis risk is certainly, when we go back to your question about acceptance here in Asia, I think basis risk is certainly one challenge. And we have to make sure, because for us as an insurer, it doesn't help us. I mean, it's more detrimental if the client has a basis risk when he's expecting a payout and he doesn't get it. It's not good for the whole parametric launch and the whole parametric concept at all. So what we're trying to do, first of all, be very, very clear about it. But I think what helps is really, and I'm coming back again to the advances in technology and data analytics, modeling approaches, new triggers. This is not only allowing us to come up with cover for new perils like we had hail size or bushfires, but actually what it also allows us is really refine existing products. So that's what we did mainly. I mean, launched a product mainly in the US, which we call now the second generation. But instead, for earthquake and typhoon taking magnitude or storm category, which is rather a coarse index, we really can now use with the data, as Edan said, the US is a beautiful a source where there's very good granular data. We can use storm intensities or shaking intensities at the specific location of the client's premises, and thereby really reducing this basis risk quite dramatically. So it's really an evolving game, and I think it's basically an art of structuring to really reduce the basis risk. But it is always going to be a proxy, and the client has to be fully aware that yes, he has to take some kind of basis risk ultimately. But
sure.
I mean, the other thing is maybe to mention also, traditional indemnity insurance has basis risk. It's just called differently. It's called deductible. It's called policy exclusion. It's called policy limits. So also there is basis risk included. But yeah, you have to explain it.
Yeah, no, that's a really good point. And actually, there's almost a basis risk in the contract language sometimes itself, as we know from your average insurance consumer who really doesn't understand sometimes what's covered and what isn't. Eden, in your work at Descartes, I know you're providing largely parametric on an insurance basis, but are you also providing on a reinsurance basis? And how do you get around sort of the basis risk between insurance and reinsurance in the parametric world?
Yeah, so yeah, first, more and more insurers are having a parametric part in their portfolio. So in that case, there is no basis risk, as they are just transferring their parametric risk into reinsurance on the same basis. On the other side, when the insurance company are underwriting indemnity risk and are transferring on the parametric basis, yes, there is a basis risk, and they are working a lot internally with their tools to minimize this. What we often see is that they usually take a buffer of protection, starting the cover at a lower level that they would expect, so that they are sure to be paid with the parametric cover when it will be triggered.
Yeah, no, one of the very interesting transactions a few years ago that I saw was a Floridian primary carrier that bought parametric risk transfer, but actually purchased that at the CFO level rather than at the reinsurance buyer level, because it was seen as almost an insurance policy for an insurer to protect them in times of extreme storms, which does seem like a different mentality to how they buy protection, perhaps, which is still something that companies are learning at the moment. Andre, on Swiss Re's book, obviously parametric risk has featured for probably 2 decades or more. You've got a long history in that. I think even around some of the early Swiss Re cat bonds were in parametric form as well. How's the appetite changed over time? Is it just something that you can't get enough of as a very large company?
Yeah, as you say, I mean, Swiss Re, we certainly were a pioneering part of the whole parametric story. And I'm just really can tell you that we are very strongly committed to grow that book, to expand it. So fundamentally, I think, yes, historically it was by virtue of available data, I think it was very much geared toward NatCat. I mean, it still is very heavily geared toward NatCat. But I think fundamentally the appetite has not changed. I think what has changed, as I said before, is really we are able to offer, due to the data situation, we are able to offer new products, and with that basically expanding this whole cake of the whole portfolio of parametric insurance. So yes, definitely. I mean, the NatCat area is there, but the secondary perils, I think, is certainly growing. Especially, I mean, last 2 years were really bad. I mean, here in this region with bushfires, with hailstorm. I mean, Aidan mentioned it, and we see quite a bit of activity there. And then, yeah, I mean, the tailor-made, the non-weather parametrics. I mean, it's all on the cards. It's all, I mean, comes down to, I think in the end, it all comes down to probably, it's probably only limited by the creativity of the insurer and the availability of data. So that's basically what it comes down to.
And I suppose also the creativity of the broker as well, because we need brokers to sell these products alongside the traditional range.
Definitely. And it's really one thing we certainly learned is I mean, it's really understanding the problem of the client, that you can find a solution, because it's too complex, or still not complex. It's certainly not a complex product, but it's probably too new still a project to that people buy it if they don't have really a problem. It's really identifying a problem, and then a parametric solution could be one solution for his problem, and not the other way around. That's certainly something when we go out selling, and we have discovered that there's interest, there's education, there's awareness creation, but we need to find a solution for a problem.
Sure, thank you. Raphael, as an investment manager focused on ILS and reinsurance, obviously Securities would, I assume, like to see more risk in parametric form. Is this an area that you hope is going to be a growth area? Would you like to see Swiss Re issuing cat bonds in parametric form again in future?
Yeah, sure. So there is, I mean, we're somewhat optimistic that it will bring new types of transactions and new players to the market, right? Because there's always an issue of, can people, or are people willing to pay premiums and finance this risk? And no doubt you can always come up with very good products, but if people just simply are not sort of able to pay those premiums, that's an issue. But last year there were some very interesting transactions. One was Sierra Re, right, brought to market on behalf of a mortgage service manager, and that was interesting in a number of ways, right? I think what that transaction illustrated is there's very good structuring expertise in the market. There's excellent risk modeling expertise. The modeler there, RMS, did a lot of work with that manager to help them understand how earthquake risk affected their mortgage portfolio. And that's for me, that's what I think is quite unique about the market. You have both the sort of structuring expertise, the risk modeling expertise, and the capital sitting behind it, and it's all independent to each other. So you should be getting a service that is quite good, quite unbiased. We definitely would want to see transactions, and typically even when someone brings us an indemnity transaction, there's always a question of whether they think they are paying the right price. And our our conversation can always end up with offering them a parametric alternative to help them reduce the price they're paying for it. So we haven't sort of executed anything as yet, but I think, for example, for wildfire risk, there are people who do believe, and probably correctly so, that they are really mitigating the impact of that risk on their portfolio. For us, it's hard to be able to quantify that mitigation, and an alternative way to do it is to enter into a parametric contract where they may recover more than they need to in certain years, but that excess recovery will help them with mitigation efforts, right? They've got to clearly finance those mitigation efforts, and that recovery can help them finance it. So it's definitely an area where we think you can go beyond what typically, again, we deal mostly at a level where we're speaking to reinsurance companies and insurance companies, but it's definitely a way where you can go beyond what typically, like you say, buyers look for, and think about other aspects of business.
Yeah, interesting. And then, yeah, the Sierra transaction from Bayview was a fascinating one because it's a direct corporate issuer essentially, and I understand that they actually knew that they had this quake issue within their mortgage portfolio and actively went looking for a solution, which ended up in a parametric cat bond, which perhaps shows an area of opportunity as the focus on climate risk within asset portfolios also grows as well. I mean, I'm thinking infrastructure portfolios and things like that. There's an enormous amount of uninsured risk in those investment portfolios that ILS can help to carve out.
Mm-hmm.
Eden, Descartes is a relatively new company and has launched specifically to focus on parametric risk transfer. What is it about this space that gets you all excited and made you want to sort of launch a specific venture in the parametric space?
I think it's really the right moment for parametrics. For multiple reasons. The first one is the availability of data. We have much more data on a much more granular basis today, especially satellite data. So, for example, today for wildfire risk for the forestry industry, I think it doesn't make sense anymore to be insured on an indemnity basis. We just can detect by satellite which are the forestry areas that are burnt, and we can pay client on this basis in a couple of days. Whereas using a loss adjusters to check if each tree has been burnt or not could take a lot of time. So first is data. Second thing is the current hard market. It was very difficult for a company, a risk manager, to switch to parametric 4 years ago when the premium were just decreasing 5 to 10%. The indemnity premium were decreasing 5 to 10% every year. It really needs courage for a risk manager to say, okay, I stop indemnity, I switch to parametric. Today with the hard market, yeah, they are trying to find solution to constrain their budget, and parametric insurance can be a lever on this. So yeah, availability of data, increased price in the indemnity market, I think are the two ingredients of success for parametric today.
Great, thank you. So I think we'll switch to some of the questions that have come in from the audience now, as there's a number. So the first one is, and I'll open this up to anybody in the panel who would like to answer, is there any issue in your territory around parametric products not qualifying as insurance due to a lack of indemnity nature? I guess this is the insurable interest question. And what has been done, or what have you done within your organization to get around that situation? And I know that this is an issue in some specific marketplaces where, for example, derivatives are not possible. Andre, is this something you come across at Swiss Re regularly? I mean, of course, you have a balance sheet to front the risk through anyway, but is this an issue at all in your day?
Yeah, no, I mean it's a very real issue because there are so many markets here in Asia. So, and each jurisdiction, each regulator in each jurisdiction has a bit of a different way of assessing it. But it is certainly something we take very seriously. So in most jurisdiction, the wordings or the cover, the product has to be approved by the regulator. Some are, and it really depends. I mean, some are a bit more relaxed about it. Some are really very, I mean, it takes a long time. But in order to issue insurance in the individual market, you have to go through that process, and that's what we have to do. And it's always the two. I mean, the main questions are on one hand, yes, what is always the case, you have to have an insurable interest, and then the question comes always up here: how do you make sure that you're not paying more? I mean, that it's not a gambling product, and that's really where we have different jurisdiction, different regulators see it differently and approach it differently. But a very I mean, here in Asia, probably more an important topic than in other regions because we have so many different jurisdictions here.
Sure, yeah, but there's actually a related question as well, asking whether insurance acts and legislation respond to parametric risk transfer well. Is that something that you see, or?
I mean, if it's really an insurance contract, then the Insurance Act would respond to it. Then you have to follow that. If it's a derivative, then it's a completely different story. It doesn't fall under. So it's really how you execute.
Yeah, looking through the questions here, there's actually quite a few questions about this. To be honest, it seems the definition of parametric as part of the insurance world is something that people find a little challenging.
Yeah, maybe Steve.
Sure.
Maybe to complete what Andre said. So today we spend a lot of time on the legal issues in every country in which we issue policies, but I think I have never seen a country where we cannot issue a parametric insurance. We are working actively with the authorities in every country, but each time we find a solution to be able to issue parametric insurance. Of course, not on a derivative basis, but on an insurance contract basis, we are able to do it everywhere.
Yeah, interesting. Another question is actually referring back to something, Raphael, that you said about how the industry is very good at coming up with good ideas, but not always amazing at selling it to the potential customers, and how it's easier sometimes in the reinsurance field where both parties are used to using modeled analysis and converting obviously a risk level to some sort of pricing and can come to an agreement on that. But it's much, much harder in the insurance world where it's a new product and maybe in a new trigger with new data forms. What do the panel feel needs to be, or what can help to overcome this? And I guess this is to anybody. Anybody want to jump in?
Should I start with my fairly naive experience, fairly naive views? But back in my former role, we did spend a fair amount of time with corporates, and where I found there was far more realistic interest in corporates is where those corporates have actually experienced something and realized that a traditional insurance policy doesn't serve their needs. So typically, this would have been wildfire protecting some energy assets or some supply chain risk. There was stuff in, and I think this is quite common, there was stuff in Europe on helping certain industries. So a transaction was for an antifreeze manufacturer servicing the airline industry, and if you had far warmer weather. So when the companies have actually experienced some of these issues, they're definitely far more responsive to be able to really figure out what they can do to mitigate that exposure, and that doesn't necessarily have to be a traditional indemnity insurance policy. I think what for me is even more interesting again is what happened with CRRE, which is where there is a lot of work done to actually understand the exposure and understand what the best way to mitigate that exposure is. At the time, we said to them, like, why come to us instead of the reinsurance market, right, where this risk usually goes? And there was a very logical and well sort of thought explanation of why they went down the way they did. And it's probably something that's only really that you can only really do with a lot of various experts helping out. I mean, that was probably a unique situation. But I'm sure there's no reason why something like that can't be replicated for other industries or in other parts of the world.
Yeah. No, it's interesting because obviously we're in a time where exposure is rising rapidly. This was a big focus of one of the sessions yesterday morning. Obviously, the Asian market, there's enormous infrastructure development going on, and just the value at risk increasing very, very quickly. I mean, I know that the market already sees parametric transactions in the sort of 150 million, perhaps larger dollar range. Do we feel the large transactions are going to continue to get bigger? Do you think big corporate buyers are going to carve more risk out of their traditional insurance programs? Andre, I'd be interested in your view.
Well, I think it's certainly potential, and I mean, as we have heard, I mean, there are some corporations, governments are certainly quite active also in securitization. But I mean, for me, it always comes down to really the development, especially in Asia. I mean, we have climate change, we have accumulation due to economic growth, due to urbanization. And I think it's quite easy to see that at one stage there's a limit to capacity that traditional insurers can provide. And then a parametric structure is actually quite an effective way to access additional capacity in the capital markets. So I certainly, I mean, it's not there yet. I think we have seen transactions, but I think it's a matter of time. Just looking at the exposures that are not shrinking but growing, or the accumulation of it.
Yeah. Eden, are you seeing larger and larger transactions coming through at Descartes, or are you seeing interest in larger transactions?
Yeah, absolutely. We regularly see the typical size we see is between 50 million and 200 million capacity, but sometimes we see larger contracts than this. For example, 1 or 2 billion capacity in the Caribbean, for example. Today, I think you already have a lot of parametric in the ILS market, mainly within sidecars. So when you invest in a sidecar, you have some parametric contracts in it for sure. I think it will develop in the cat bond market given the increased size of transaction and also the increase in write-on lines.
And Raphael, from the investor side, obviously one of the interesting things, I guess, for the ILS fund managers of the world is that as parametric transactions grow, they are insurance transactions that, because they're based on data, they're much easier to invest in and much more readily available sometimes, I guess, to the ILS funds as well. Are you seeing an increasing number coming to markets?
We definitely like it. We're probably not seeing as many as perhaps the people would have expected if you maybe were thinking about how the market would develop 10 years ago. You probably expected to see more of these. And I think a key issue is just are people able to afford these premiums, right? And in some situations, they're not very large, but it's just a question of do people want to, or do people have the need to get some of these risks off their balance sheet? I still think there's definitely more work to be done to really understand perhaps ways by which they can finance those risks. The current way we do it, right? That the way you finance risk is you pay premiums annually. And you make a recovery at some point in time, perhaps if you continue to buy that policy. But there might be other ways of doing it, and I think that could be something that needs to be addressed to figure out how more of this risk can come to the capital markets. You make a good point in that with a parametric deal, it should in theory be quite straightforward to understand the risk. More of the efforts, I think, generally in the ILS market have been focused on modeling indemnity risks really over the last 10 years. So it can take us, even us at Securities, it can take us sometimes more time to understand and model parametric risks. Perhaps typically it's because the structures are quite different with every transaction. And that's definitely something we would encourage, to just encourage the market. But I mean, should the market, for some reason, completely turn in that direction, it's something, again, people can respond to. We see at our sort of our own firms and at our peer firms that we're all fairly data-driven. And being data-driven means you focus on what data you can get hold of and understand the flaws of that data to help you come up with your risk structures and your analysis. So I guess what I'm trying to say is, even though it sometimes may seem like it's fairly easy to understand, and you definitely get a lot of help with the independent modeling, to get your heads around it and to help you compare it to other transactions you see can sometimes take a bit more time.
Sure, thank you. So just a few final words perhaps from each of you on maybe your vision for the future for parametric risk transfer and how you think this market's going to develop. Let's begin with you, Andre.
Yeah, I think we said it all. I mean, it's certainly an area, I mean, I see, given the climate change, given also, I mean, we haven't touched on directly, is also a fundamental change in the corporate landscape. I mean, moving out of this tangible world into more the intangible assets, I think this lends itself to parametric. So I certainly see a very significant potential. And now is, I mean, I think one effect of the whole COVID situation is, and I think somebody mentioned it, is that corporations and people are getting a bit more risk aware and say, well, what else do I have in my portfolio or my risk landscape that I wasn't so aware of? So I certainly see very, very significant potential, and it's a good way, I mean, a good place to be in, actually.
Great, thank you, Andre. Eden, some final thoughts from you?
Yeah, I hope it will continue to grow as it is our only business, Parametric. So yeah, I really see the market continue to grow thanks to availability of data and the new risk awareness or updated risk awareness of risk managers within companies. And yeah, it will definitely grow. And also, as more and more clients are coming to the market, they all discuss with each other. For example, we have done a contract to cover a French company against earthquake in Mexico on a parametric basis. And now all the risk managers within the top French companies are discussing about it. So yeah, as when you do one contract, it just opens the door for many more.
Great, thank you. And Raphael? Raphael?
Sorry, I was on mute. What I'm hoping to see in the medium term, I guess, is this enhancement of how people sort of come to market. And again, I keep harping on about this CRE point, but I do think that was a great example of how things can get done, right? How risk can be identified. And so in the medium term, what I would hope to see is that these various experts at different firms work together to be able to assess this risk and bring some of these interesting transactions to market.
Great, thank you. Okay, that's about all we have time for. We've run over just by a few minutes, so not too bad. Thank you very much to the panelists, Andre, Eden, and Raphael. That was a very interesting discussion. Thank you everyone who tuned in. This will be available on demand for those of you who joined late. Just visit the same URL in a few hours' time and it will be packaged up and available for you. So later on today, we have a keynote discussion with Paul Schultz, the CEO of Aon Securities. So hopefully you can join us for that. Thank you for tuning in and talk to you all soon. Thanks, panelists.
Thank you.
Thank you.